You know, that life insurance policy you've been paying into, it might be more than just a safety net for the future. It could actually be a source of cash for you, right now. But how do you do it? Today, we're going to break down all the options and cover the critical things you absolutely need to know before you make a move. So maybe you need some cash, right? Could be for a home repair, college tuition, or just one of life's unexpected curveballs. And you remember that life insurance policy you've had for years. Can you actually tap into it? Well, the answer is very often yes. So let's dive into how your policy can become a source of funds when you need it most.
Okay, so before we even get into how to pull cash out of your policy, we have to answer a more basic question. Is there any cash value building up in there in the first place? Let's find out.
It really all comes down to the two main types of life insurance. Think of term life like renting an apartment. It gives you coverage for a set period, but you don't build any equity. Permanent life, on the other hand, is like owning a home. It's designed to not only give you coverage, but also to accumulate a cash value you can actually use. Now, once you're in the world of permanent life insurance, you've got a few flavors to choose from. There's whole life, which offers really predictable, steady growth. Then you have universal life, which gives you more flexibility with your payments. And with variable life, you can actually invest the cash value, which means higher growth potential, but also, you guessed it, more risk.
All right, so you've confirmed you have a policy with cash value. Awesome. What's the most direct way to get to it? Well, that would be our first option, a simple cash withdrawal.
Now, here's the really big deal with the withdrawal. You can typically take out an amount equal to whatever you've paid in premiums. That's called your cost basis, and it's completely tax-free. It's pretty much the simplest way to get your own money back without getting the IRS involved. This is super important to get straight. A withdrawal is not a loan. You're not going to pay interest, and you don't have to pay it back. But, and this is a big but, it permanently reduces your policy's cash value and, just as importantly, the death benefit that would one day be paid to your family. Okay, let's break it down. Pros versus cons. The pros are pretty compelling. You get immediate cash, it's tax-free up to what you've paid in, and there's no interest. The cons, though, are serious. It permanently lowers the death benefit for your loved ones, and if you take out too much, you could actually risk the whole policy lapsing.
But what if you're thinking, hey, I need the cash, but I really don't want to permanently shrink the payout for my family? Well, that brings us right to option number 2, the policy loan. One of the huge perks of a policy loan is that the money you get isn't considered taxable income. But, and this is a huge but, that's only true as long as the policy stays active. If it lapses for some reason while you still have a loan, you could be staring down a surprise tax bill.
So what's actually happening here? Well, you're essentially borrowing money from the insurance company itself, and you're using your own cash value as collateral. It works just like a secured loan. You will owe interest, but the good news is the repayment terms are usually incredibly flexible. So on the plus side, it's pretty sweet. You get tax-free access to cash, no credit check is needed, and you can pay it back on your own schedule. On the flip side, you got to be careful. Interest does build up, and if that loan balance gets too high and causes the policy to lapse, that loan money could suddenly become taxable income. So, which one is it? Withdrawal or loan? Look, a withdrawal permanently cuts your death benefit, but that money is yours, free and clear. A loan keeps your death benefit intact, as long as you manage it right, but you have to deal with that accruing interest. The best choice really truly depends on your specific goals.
All right, now for option number 3. And I gotta tell you, this is the most drastic of them all, and it's a one-way street. It's called a full surrender, where you terminate the policy completely.
What this means, in plain English, is you're tearing up the contract. The insurance company will give you the cash surrender value, but first, they're going to subtract any surrender charges, which can be pretty steep in the early years, and of course, any loans you haven't paid back yet. Yep, this is the big red button. You are permanently ending your life insurance contract. That means no more premium payments, but it also means no more death benefit. It's an irreversible move, but it can be a clean exit if you are absolutely certain you don't need the coverage anymore. And you can bet the pros and cons really reflect how final this decision is. Pro, you get all the available cash, and you can stop paying those premiums. Con, you lose your life insurance coverage forever, and any money you've gained above what you paid in will be taxed as regular income. Okay, there's one last way we need to talk about for accessing money, and this one is really designed for times of serious need. It's called an accelerated death benefit, and it's for when you're facing a major health crisis. So,
If you get diagnosed with a qualifying terminal or chronic illness, these little add-ons to your policy, they're called riders, can let you access a huge chunk, sometimes even up to 100% of your death benefit while you are still living.
Look, the benefit here can be absolutely life-changing. It can provide a large, typically tax-free amount of money for medical care or just to improve your quality of life. The trade-off is very simple. Whatever amount you access now is just deducted from the final death benefit your family will receive later on.
All right, let's put it all together and look at these 4 options side by side. You can really see the key differences here. Look at the tax impact and what happens to your death benefit with each one. This is a fantastic way to see which approach might line up best with what you need. And this really brings us to the single most important point of this whole thing, and it's summed up perfectly right here. Each method has long-term consequences you must understand fully before acting. This is not a casual decision. The right choice for you depends entirely on your unique financial situation and your long-term goals.
So, after all that, what's your next step? This is a big decision, and you want to be confident you're making the right call. That's where getting some personalized advice can make all the difference. The annuity expert can help you compare different life insurance policies and really understand your options. Best of all, their services are always free. You can give them a call at 770-755-1565 or just visit their website. Making the smartest move for your future always starts with having the right information.